Welcome to Manifested Publishers.
Hello students, welcome to Manifested Online Classes. My name is Mr. Kimani. I want us to continue with the revision for financial reporting and we'll still continue with the revision for November 2019. And in this session of this class, I want us to look on question number 2. Basically, that question came from the topic of published financial statement, which is basically a common question in this paper. And you go through the question, it reads, the following trial balance has been extracted from the accounting records of Skytex Limited as at 30th September 2019. So in our case, you're given the trial balance. First of all, we have 6% convertible loans. Loan notes, and then we have ordinary shares, we have retained earnings, revenue, cost of sales, distribution cost, administrative expenses, inventory as at 30th September 2019. We have trade and other receivables, trade and other payables, finance cost, investment income, current tax, deferred tax, property at cost. We have accumulated depreciation on 1st October 2018. We have plant and equipment. We have it accumulated depreciation. We have bank balance. We have investment property. And then we have suspense account. And then from there we have additional information. In the additional information, we have note 1 up to note number 7. We're going to go through that as we have some workings. And then if we go to the requirement there, we require to prepare the following statements, the following financial statements, suitable in a suitable format for publication. One, a statement of profit and loss for the year ended 30th September 2019. Two, a statement of changes in equity for the same year. And number 3, a statement of financial position. And then we are told all workings should be done to the nearest 1,000 of a shilling. So basically that question was requiring the preparation of 3 components of a published financial statement, statement of profit and loss, statement of changes in equity, and a statement of financial position. Now, what we need to do, we need to go through the additional information note 1 up to note 7. First of all, we do some workings, and then from there we prepare what is required. So this is the revision. And this still the paper for November 2019. And this is a question 2. This is a question 2, and we start with the workings. So we go through note number 1, and we are told that Skytex Limited entered into a contract with a customer with performance obligation, where performance obligation is satisfied over a time. And then you're told the total contract price was 45 million, with total expected contract cost of shillings 25 million. And then we are told progress toward completion was measured at 50% on 30th September 2018. That is now the end of the previous year, and at 80% on 30th September 2019. That is now the end of the current year. And then you're told the correct entries were made in the year ended 30th September 2018, but no entries have been made for the year ended 30th September 2019. Now, what we need to do in respect to that particular point number 1, in respect to this contract which was entered with customers, is basically to determine the amount of revenue which was supposed to be recognized in the current financial year, and also the cost which was supposed to be recognized in the current financial year in accordance with IFRS 15. So therefore, we determine the revenue to be recognized. We determine the revenue and cost to be recognized in the year ended 30th September 2019. So what we are told is that this particular contract, in the year 2018, it was 50% complete, and that means that the revenue and also the cost which were recognized in the year 2018 were 50% of the revenue and cost of that contract. And then we are told in the current financial year, the contract was basically performed to an extent of, or basically it was deemed to be 80% complete. So what that means is that the revenue which will be recognized in the current financial year will be equal to 80%, because we are told the contract is 80% complete, minus what was recognized in the previous year, that is 50%. So mean that during the current year we are going to recognize revenue equivalent to 30%, and then we multiply that with the revenue, with the total contract price, which is 45 million. So we get 30% of 45 million. 30%, 0.3 times 45 million. That will give us 13.5 million. Now this 13.5 million, one, it will be accounted for as a revenue, and two, because this amount has not been received, it will also be recognized as a receivable. So therefore, this will be a part of the revenue. It will be recognized as a revenue for the year, and two, it will also be accounted for as part of the trade receivables, because this is just like credit sales, whereby we recognize that as revenue and also we debit that in the trade receivable. Still, we also need to recognize or basically to determine the cost which will be recognized in respect to this contract in the current financial year, and still the computation will be the same, 80% minus what was recognized in the previous year times now the cost of that contract. The cost of that contract is 25 million. So we get 30% of the costs, that's 0.3 times 25. So that will give us 7.5 million. 7.5 million. Now this 7.5 million being the cost of that contract, one, we are going to add it to the cost of sales. We are going to include that as part of the cost of sales. And two, because this cost is yet now to be paid, still it will be recognized as part of the trade payable. So when preparing the statement of financial position, we're going to recognize that as part of the trade payable. So therefore, that what was supposed to be done, and basically that is in accordance with IFRS 15. So we proceed to note number 2, and we are told on 1st April 2019, Skytex Limited has was notified that ex-employees had initiated court proceedings against them for unfair termination. Legal advice was that 80%, or there was 80% chance that Skytex Limited would lose the case and would be required to pay an estimated cost of 5.06 million in damages on 1st April 2020. Based on this advice, Skytex Limited recorded a provision of 4 million on 1st April 2019 and has made no further adjustment. So the provision was recorded in administrative expenses and in trade and other payables. And then you are told Skytex Limited cost of capital is 10% per annum, and the discount factor is 10% for 1 year, is 0.9091. So basically in respect to this particular legal case which was initiated against the company, basically the company expects to pay some damages. These are form of a contingent liability, and basically whenever there is a contingent liability, a company should make a provision which is equivalent to the present value of what is likely now to be paid. So therefore, in respect to that point number 2, what we need to do is basically to determine the provision for the contingent liability, which was supposed now to be made by the company as at the end of the year, that is on 30th September 2019. So the first thing we need to do here is basically to determine what is the present value of these particular damages which will be paid. And in our case, we are told that the damages which are expected to be paid, by the company is 5.06 million, and what we need to do is basically to discount this, or basically to get the present value of these particular damages, because we are told they will be paid on 1st April 2020. So 1st April 2020, 1st April 2020, and basically in our case we are told that that particular legal case was instituted on 1st of April 2019. So what that means is that these particular damages will actually be required to be paid by the company in 1 year's time. So therefore what we need to do is basically to discount that, and basically for us to discount that we need to multiply that with the present value interest factor, which we are given as 0.9, that is 0.9091. So we multiply the two, so we get the present value of the damages which will be paid, and basically that will be equivalent to the contingent liability. So the company at the end of the current financial year was supposed now to make a provision equivalent to that contingent liability. So let's multiply these two. So we have 0.9091 times 5.06, and that will give us, to the nearest whole number, it will give us 4600, or basically 4.6. So what that means is that at the end of the current financial year, this company was supposed now to make a provision equivalent to 4.6 million. But what we are told, if you go back to note number 2, paragraph 2, we are told that the company had made a provision of 4 million. So, but in our case, we have said that a company, or this company, was supposed to make a provision of 4.6. So therefore, at the end of the current financial year, the company now will need to make an additional provision which is equivalent to the difference. Our difference in our case here will be equivalent to what? 600,000. So therefore, this additional provision which will be made, it will be accounted for, one, as part of administrative expense, simply because what we are told is that this particular provision which was made of 4 million, it was accounted for as administrative. 2, and this particular provision, because it is money which will be set aside, still it will be accounted for by the company as part of what? Trade payable. So therefore, in respect to that provision, the additional provision of 600,000, we are going to account for it as administrative cost, and 2, we are also going to account for it as a part of the trade payables. Now still, in the last note, or basically in the last sentence of note number 2, we are told Skytex Limited cost of capital is 10% per annum, and the discount factor at 10% for 1 year is 0.9091. So basically what we also need to do is to compute something known as a finance cost, because anytime now a company do have a liability, there is something known as the finance the finance cost. Now the finance cost in respect to this contingent liability, you can compute it here as working 3 finance cost. So the finance cost will be equal to the company's cost of capital, which is 10%, times the contingent liability. Our contingent liability is 4,600, or basically 4.6 million. And in our case, we will compute a finance cost equivalent to 6 months, because what we are told, legal case, we are told in our case it was instituted on 1st of April 2019. And what we know is that the current financial year is ending 30th of September 2019. So if we are to count that period, or basically the number of months which we have there, so basically we have April, we have May, we have June, July, August, and then we have September. So basically these are 6 months. 6 months. So therefore, the finance cost which will be recognized in the current financial year will not be for the whole year, but rather it will be for 6 months. So therefore, what we need to do is basically to multiply that with 6 all over 12, and basically we get now the amount which will be recognized as a finance cost for the current financial year. So we have 10% times 46 times 6 all over 12 and basically that will give us 230. Now this particular 230, one, it will be included as part of the finance cost, and two, because it had not been paid, still it will be recognized as part of the trade payable. So therefore you can say that this will be part of our finance cost, and two, it will be part of the trade payables. It will be part of trade payable. So in our case, we are through with that particular point. So let's move to the other note, that is note number 3. In note number 3 is about depreciation, which is a little bit simple. We are told the company's policy on depreciation is to charge depreciation on building on straight line basis to a nil residue value at the rate of 2% per annum. And then we are told in the other sentence, the plant and equipment should be depreciated on a reducing balance basis at the rate of 12.5. So what we need to do, we can have now working for here. We need to compute the depreciation for the current year. So the current year, we have to remember, ended 30th September 2019. So one, we compute the depreciation on buildings, and we are told that depreciation will be computed on straight line basis at the rate of 2%. So we take 2% of the cost because depreciation is on straight line. Now, if we go back to the trial balance, we go to where we have property, because we know property includes land and building. So we have the value of land there being 60 million. So mean that the difference there represent the cost of our building. So if we take 170, so these include the cost of land and building, we less the cost of land, which is 60. So we will be left with the cost of building. So we get now 2% of that. So let's compute that. We have 110,000 times 0.02. That will give us 2,200. And then we also compute now the depreciation as per note number 3. We compute depreciation on plant and equipment. And we are told depreciation here is computed at the rate of 12.5% of what? Of now the net book value, because it is computed using the reducing balance basis. So we take the cost. If we go back to the trial balance, the cost in our case for plant and equipment is given as 56. And then we less the net, not the net, rather the accumulated depreciation, which is 18,000. And then we get now the depreciation for the current year. So let's compute that. So we have 56,000 minus 18,000 times 12.5 times 12.5%. So that will give us 4750. So basically in our case now, from that we can compute the total depreciation for the year. And the total depreciation for the year for the two assets, so which will be equal to 2,200 plus 4750. So that will give us a total of 6950. So this 6950, unless told otherwise, we always account for it as part of the cost of sales. So therefore, when taking into account the cost of sales, we are going to include now the depreciation for the year. So we are through with that note 3. Let's move to note number 4, and we are told the company issued shillings 25 million 6% convertible on loan notes on 1st October 2018. 1st October 2018 is the start of the current financial year. And then we are told interest payable annually is payable annually in arrears, and then we are told the loan note can be converted into one ordinary share for every shillings 2 of the loan note on 30th September 2020. And that is in 2 years' time. And then you're told similar loan notes without conversion rate incur interest at the rate of 8%. So in this particular case, there is a point there which is very, very important, that these particular loan notes which were issued by this company, they were issued at the rate of 6%, or basically this company offered to pay an interest of 6%, an interest of 6%, but we are told similar loan notes were offering, or basically were paying an interest of what? Of 8%. So what that means is that for this company now to make these loan notes marketable, definitely they have to be offered at a discount, because in this case, being a rational investor, you are given now an option to invest in this particular loan notes issued by this company, and also invest in other loan notes. You will go for loan notes issued by other companies which are offering an interest of 8%. So therefore, in this case, the company was supposed now to issue this particular loan note at a discount. At what? A discount. So therefore, what we need to do is basically now to determine the issue price. Now, when determining the issue price, what we do is that we are supposed to get now the present value of the expected cash flows, the present value of the expected cash flows, or basically the amount of money which will be paid by the company, of which this cash flow, usually it is in two forms. One, it is in form of interest, and also it is in form of what we refer as the principal amount, which will be paid back in the event that the holders of this particular loan note decide not to convert them into ordinary what? Shares. So therefore, the first thing we need to do is basically to determine now the issue price, which will be equivalent to the present value of the expected future cash flow. So let's determine that. We determine now the issue price of 6% convertible loan notes, and basically in this case I've said that this issue price would be equal to the present value of the expected cash flows, and basically remember you have said that this cash flow will be in two forms: interest and also the principal amount. So in our case, let first of all we compute the interest which was supposed to be paid. Interest this company was supposed to pay per annum. So when computing the interest, we take now the coupon rate. The coupon rate is this 6% times now the par value of the loan note, which was 25 million, and then we already know the principal amount. The principal amount in our case, unless told otherwise, it is always equal to the par value, that is 25 million. So we compute the interest which was supposed to be paid annually. That will give us 1.5 million. 1.5 million, and basically this 1.5 million being the interest which is supposed to be paid annually, it will be paid for the next 2 years. That is the end of 2019 and the end of 2020. So therefore, we are going to discount these interests which will be paid for the next two years, and basically these are like an annuity. So two, we also need to discount now the principal amount. The principal amount in our case, we have said it will be equivalent to 25. So I think we can do that. So what we have said is that in year one we have the cash flow which will be paid. This company in year one, it will only pay interest, which is 1.5 million. We can just have these in thousand of shillings, 1,500, and then we have the present value interest factor. Then we have a column for the present value. So then in year two, the company will have to pay two items. One, it will pay the interest of 1,500 or 1.5 million, and two, the company will pay the principal amount. The principal amount is what? 25. So therefore, we add those two figures. So we have 25,000. So we have 25,000 plus now the interest, because we have said at the end of second year, if now this convertible loan stock will not be converted into ordinary shares, the company will be required to redeem them or to retire them. So the amount the company will be required to pay to the holders of this particular loan stock will be equivalent to the amount they had paid, 25 million plus the interest for the second year. So mean that in total, the company will pay 26,500. So and then in this case, we discount this by multiplying that with the present value interest factor at the rate equivalent to the market interest rate, which is 8%. 8%. So we have 0.926. Then we also have for year 2, 0.857. So we multiply these two figures. We have 26,500 times 0.857. That will give us 22,710 or 711 to the nearest whole number. And then we have 1,500 times 0.926, which will give us 1389. So we add the two values there. We get 22,711. Yes, and that will give us an amount of 24,100. So what that means is that when these 6% loan notes were being issued by the company, they were issued at a discount, because you can see the par value was 25 million, but the company issued them at a discount at a lower price of 24.1. So therefore, this is the amount now which was supposed to be credited in the 6% convertible loan note. In other terms, we refer to this as the amortized cost on the date of the issue. In our case, we are told the date of the issue was 1st October 2018. But there is another point which we are told. If you go to note 4, second paragraph, we are told Skytex Limited recorded the full amount in the liabilities. So what that means is that the amount now which was recorded as a liability is not the issue price of 24.1 million, but rather the full amount of 25. And that's why if we go back to the trial balance, in fact, the first item, we will be able to see that the amount now which was the first item which we have there is 6% loan note. So what that means is that when these particular loan notes were issued, so we can just prepare that account, 6% loan note account. So when they were issued, we are told that the company basically credited this particular account, this account with an amount of 25 million, or basically 25,000. But we have said because they were issued at a discount, the amount which was supposed to be credited here was how much? 24.1. So therefore, we can say that the correct amount which was supposed to be here was 24.1. Basically, we can have it here 24.1, because now when the company issued this particular 6% loan note, the amount now which was received was this one, which was supposed to be debited in the bank account, and then it was supposed to be credited in that account. So therefore, the amount which was supposed to be credited here was supposed to be 24,100, but because the company had already accounted for that amount of 25,000, so the difference, which is 900 here, this is supposed to be recognized as a form of a reserve. In fact, we refer to that as the conversion option reserve. The conversion option reserve. So what that means is that when preparing our statement of changes in equity, we are going to have a reserve, which is known as a conversion option reserve. Basically the amount of 100, sorry, not 100, but rather 900,000. So let's go back to that particular point there, point number 4. And we also need to determine the interest for the current financial year, or basically the finance cost. So in respect to those 6% loan notes, so we can just prepare something known as a amortization schedule. Amortization schedule. amortization schedule. Now, in preparing this schedule, we just need to prepare it for the first year, that is year 1. So first of all, we can have now the amortized cost, at the start of the year. And basically, we know that the amortized cost at the start of the year was the amount of 24,100. So then from there, we need to determine the finance cost. So the finance cost is determined using the effective interest rate, which is equivalent to the market interest rate, which is 8%. And then to this, we deduct the cash which was paid by the company. The cash which was paid by the company the first year, we say it is an amount of 1,500. So that one, we already have it. So that one will be deducted. And then finally here, what we need to do is basically to have now the amortized cost at the end of the year. The amortized cost at the end of the year. So basically, this amortized cost at the end of the year, which we are going to have there, is the figure now which will be taken to the statement of financial position, or this 6% loan note in the statement of financial position, they will be reported at that value. So let's compute that amount there. We start by computing the finance cost. So the finance cost will be equivalent to 8% of the amortized cost at the start, 24,100, and that will give us 1928. And then let's compute the amortized cost at the end. So which will be given by amortized cost at the start, 24,100, plus the finance cost minus the cash which was paid. Yes, and we get 24,528. So what that means is that this 6% loan notes will be reported in the statement of financial position at that value 2. The amount now which will be accounted for as a finance cost in the income statement or in the statement of profit or loss is the amount of 1928. But there is still some information which are given in note number 4, second sentence. We are told Skytex Limited recorded the full amount in the liabilities. I think we dealt with that. And then we are told has recorded the annual interest payment. The annual interest payment is what was paid. This is the amount of 15 made on 30th September 2019 of 1.5 million in finance cost. So basically what we have said is that this is not what is supposed to be accounted for as a finance cost, but what should be accounted for as a finance cost is 1928. So therefore, what we are going to do in preparing the statement of profit or loss, we are going to take now the finance cost which is given in the trial balance, the amount of 6,200. We deduct what has been included there, and that is 15, because this is not what was supposed to be included. And then we, after deducting that, we add the correct figure of what? Of 1928. Yes. So basically that what is required in that point number 4. And then we move to the other note, that is note 5. In note 5, what are we told? We are told that the balance of current tax in the trial balance relate to over or other provision from the previous year. So first of all, if we go back to the trial balance, we will be able to see something called current tax. In fact, below the investment income. So that amount of 650, if at all it is on the credit side, that is always an over provision. But if it was on the debit side, it was supposed to be under provision. So what we need to remember according to IAS 12 is that over provision should be used now to reduce the provision which will be made in the current financial year. So that means that that amount of 650 will actually be deducted from the provision which will be made in the current financial year. So, and in the other sentence, we are told the tax estimate for the year ended 30th September 2019, that is the current year, is 10.5 million. So from that figure of 10.5, we are going to raise now the over provision from the previous year of 650. And then we are told, in addition, there has been a decrease in the taxable temporary difference of shillings 10 million during the current year. And then we are told that the Skytex Limited pay tax at the rate of 30%, and movement in deferred tax are taken to the statement of profit and loss. So I think in respect to that last sentence, we need to compute the deferred tax income, or basically the deferred tax expense for the current financial year in terms of preparing the account called the deferred tax account. Now, in the deferred tax account, the first thing we should start with is basically what we have in the trial balance. If you go to the trial balance below the current tax, we have something called deferred tax. So that deferred tax, even if you are not told because it is on the credit side of the trial balance, it is automatically a deferred tax liability, because we know that liabilities do have a credit balance. And then if we go back to that note 5, I think in a second sentence, we are told, in addition, there has been a decrease in taxable temporary difference of 10 million during the current year. So basically what that means is that if there was a decrease in taxable temporary difference, then this amount here also reduced with an equivalent amount. So what we need to do is to compute now the deferred tax liability at the end of the year, which will be equal to the opening balance. And then in our case, because we are told the temporary difference reduced with 10 million, that means that the deferred tax liability still reduced with 10 million. So the reduction will be equivalent to 30% times 10 million, or basically in our case we take that in thousands of shillings, which will be 10,000. So we compute now our deferred tax liability at the end of the year, which now will be the figure there. So we have we first of all compute that. I think that will give us we have 0.3 times 10,000, and then we deduct that from 13,900. So that means that our deferred tax liability at the end of the year will be 10,900. So the difference here is basically the amount of deferred tax which will be reported in the statement of profit and loss. So the difference, I think it will be on this side, which will be 3,000. So if you have a balancing figure on this side, this is the amount now which will be taken to the income statement, or basically in the statement of profit and loss. And if the balancing figure occurs on the debit side, usually that is a deferred tax income, simply because the income statement will be credited. So what we know is that when preparing the income statement, we debit it with the expenses and then we credit it with the income. So therefore, that will be a deferred tax income. So therefore, when computing now our totals here, first of all, will be 39. So when computing now the income tax expense, tax expense for the current year, which now will be charged in the income statement, this always comprises of the two components of tax, the current tax and the deferred tax. So the current tax estimate, you're given that in note 5, which is 10.5, and then to this we said we less the over provision of the previous year. The over provision was 650, and then to this we should add the deferred tax expense for the current year. If we have a deferred tax income, that should be deducted, because in our case you can see we have deferred tax income. So we don't add that here because these are an income. Rather it should reduce now the current tax expense. So we less 3,000. So that now we get the amount of income tax which will be charged in the income statement. So we have 10.5 minus 650 minus 3,000. Yes, and that will give us a figure of 68.50. That is the amount of income tax which now will be charged in the income statement. So I think in our case we are through with that. So let's move to the other point there. Point 6 or note 6. We are told on 1st February 2019. Skytex Limited issued 1.5 million ordinary shares at full market price at shillings 16 per share. and then we are told the proceeds were credited to the suspense. So basically that is wrong, because whenever the company issues shares, the amount of money which has been received should be debited in the bank and then credited in the ordinary share capital at par value, and also in the share premium at any share premium. So therefore, what you're going to do when preparing the statement of changes in equity, which is required in Part B, we are going to take into account those particular shares, because it was supposed to be added to ordinary share capital and also the share premium. So we are going to compute that when doing that Roman Part B. And then finally, we are told the investment property in the trial balance are stated at their fair value as at the end of the previous year. And then we are told during the current financial year, their fair value was 121.5. So basically, in respect to that, according to IAS 40, that is International Accounting Standard number 40, if at all the fair value of the investment property has increased, that revaluation gain should be accounted for as an income, or basically as part of the other income. So therefore, what we need to do is to determine the revaluation gain on investment property, and that will be equivalent to 121.5 million minus now the fair value at the start of the year, which was 120 million. So that in thousand of shillings, it will be 1500, or 1.5 million. And basically I've said that these will be accounted for as part of the other incomes. That is according to IAS 40. And 2, when preparing our statement of financial position, this particular investment property will be reported in the statement of financial position at their at their fair value, that is 121.5. So I think in our case we are through with the workings which were required in that question. So what we need to do, let's move to Part A of that question. I think having done all these working, then Part A become very simple. So we have a statement of profit or loss. So the name of the company is Skytex Limited. Skytex Limited statement of profit and loss, which is for the year which ended 30th September 2019. 2019. And I think before we do that question, we can first of all take a short break, and then we come back. We prepare that statement of profit and loss.